Saurabh Mukherjea joins us now. Saurabh, good morning. Thank you for joining us. Saurabh, thank you for sending me across your new book. It's reached my desk last evening, and I promise that next time when we interact, I would have read and we would have discussed that book.
Right. Thank you.
Okay. Saurabh, I must admit that when Aisha and me were discussing the point in small and mid-cap stocks, the point which, your point struck me, that stick to market leaders, stick to companies which in a sense are gaining market share. So let's understand that how does this now work in small and mid-cap stocks? Because the market share theorem which you talk about is perhaps only applicable to large cap stocks. Reliance will gain market share, HDFC Bank will gain market share, private banks will gain market share. But at a time when some of these large cap stocks are expensive and the temptation to buy good quality small and mid cap stocks is there, how does one go about choosing your spots?
So the point we've made in our Little Champs portfolio, which I have to say upfront is shut to inflows. We are not taking any more money in Little Champs. But the point we made when we were raising money through the last 12 months, and that was just like Nestle dominates baby milk powder and Asian Paints dominates paints. Similarly, say Garware Technical Fibers dominates the global market for commercial fishing nets. Right? They have, I think, more than 50% market share globally in commercial fishing nets. Commercial fishing nets are an essential commodity for Norwegian fishermen and Japanese fishermen and Australian fishermen, and Garware Technical Fibers is their chosen vendor, right? So if you buy the dominance of Garware Technical Fibers, and there's a whole bunch of reasons why over the last 20 years, Vayu Garware from his Pune operation has been able to build this fabulous franchise. But if you buy the underlying barriers to entry that Vayu Garware and his firm have built, then obviously as the world recovers from the pandemic and our country also recovers from the pandemic, you'll see a nice story playing out here where a market leader continues to chug out 20-25% earnings growth with return on capital significantly above cost of capital that throws off cash flow, which Garware puts back into the business and carries on growing this niche market leader. So we've discussed on your program several times GMM Fodler, so I don't want to repeat that again because it's a story that I think your viewers now understood very well. But a Garware Technical Fibers or an Alkyl Amines, these are all companies with dominant. By dominant, I mean 50, 60, 70, 80% market share in niche industries. And hence, they behave very similar to an Asian Paints or a Nestle. They give you steady compounding over long periods of time. And that will be especially relevant as the world and India comes out of COVID and the economic recovery proceeds apace.
Saurabh, there are two types of companies, Saurabh, and again I'm breaking it just for our viewers. Is one companies which keep on generating a lot of cash flow. Those are great outstanding businesses to invest in because market is about buying future cash flows. But then there is the other set of companies which will do very well when there is an economic recovery around the corner, which have a bit of operating leverage and a cyclical advantage. In the medium term, in the short term, do you think one is better off tilting towards names which will benefit because of economic recovery, steel, cement, metals, because that's where the price action now seems to be moving?
No, so it feels very seductive. You're right, Nikunj. It's very seductive to say, let's buy these companies with operating leverage. I think one runs into two problems. Firstly, many of these companies with operating leverage have broken balance sheets. So they will use your desire to purchase the stock and the near-term share price recovery. They will use to raise capital, and that will take away much of your upside. The second is, suppose you get in today, right? You say that recovery is an early stage. Let me buy steel, cement, and benefit from the early upswing in the economy. How do you know when to get out, right? You're not going to get a text message from the big man in the sky that this is now the time to get out, right? So the exit decision is a very difficult decision, and it's not apparent to me. Too many people out there, including myself included, have a great handle on it. You're far better off buying a well-run market leader who actually will also benefit from the recovery. So I'll use my book actually to make this point. So my publisher is the largest publisher in the country, and what they told me back in February, March or March, when they saw COVID hitting us, they said, we'll hold your book back by 5 months. Obviously, I wasn't very happy about it, right? And they explained to me that, look, if we publish this in March, April, with the lockdown underway, sales will be muted. Amazon isn't delivering books through March, April. Bookshops are shut. You will suffer, right? So they explained to me as supplier, you can think of me as a supplier to this publisher. They explained to me the merits of holding it back. They held the book back till 16th August, and we are seeing the benefits of that, right? Book sales in India through June, July, and halfway through August have recovered very sharply, much like everything else, motorbikes, tractors, undergarment sales. Book sales have also picked up, and the fact that I'm working with a market-leading publisher who has the wisdom to hold back firepower and then load up its guns and fire when the recovery is proceeding, I benefit from that as a supplier. And whoever is the shareholder of my publisher, the shareholders are in Europe and America, they benefit from this sort of behavior. So Garware Technical Fibers or alkyl amines also behaves like this, and you and I, as shareholders or investors in these sorts of high-class companies, can benefit from the recovery. And it's a much smoother ride. It's a much smoother ride, and I don't have to second guess Vayu Garware and sell the stock a year out, because I've seen that over 20 years, this man has built a great franchise.
Okay, just going to check in on what the market rates are settling in at. We had that gap down of about 1%, and we're staying put at that. Sub the 11,300 mark for sure. Muthoot, Can Bank, Motherson Sumi, ICICI Bank, Adani Enterprises, these are your big losers. Saurabh, where is it that you stand in the entire financials debate? I mean, one knows that banks in particular are going to be blown hard when it comes to NPAs once the moratorium gets lifted, and only that's when you're going to get the clearer picture. But do you think the time to buy into even the top 5 names is now, when they're beaten down and when they're underperforming the rest of the market?
I think we've emphatically made a case, Aisha, that it is now to buy the best franchises, not just on the lending side, but also on the asset management insurance side. And here's our logic. The only large sector in the Indian economy which isn't consolidated, right, which doesn't have one or two players taking away 80-85% of the profits, the only large share in the Indian economy which isn't consolidated in this manner is financial services, right? So you've got a plethora of banks, 10,000 NBFCs, 30-40 asset management companies, so on and so forth, right? And for several years, we've been trying to figure out, when will this sector consolidate, right? If baby milk powder is consolidated and undergarments is consolidated and paints is consolidated, we believed it was a matter of time before the financial services industry consolidated. And as soon as COVID hit, right, we did the maths, we figured out there'll be balance sheet write-offs, and we said this is the trigger. COVID will drive massive consolidation, both in banks and in NBFCs. Weaker lenders, I think, as you folks were discussing 5 minutes back, the weaker lenders will not be able to raise capital, right? The PSU banks, I don't think, will be recapitalized by the government of India, given the fiscal constraints that the government faces. So the PSU banks account for 65% share. As they shed share, as the PSU banks shed market share, the top private sector banks consolidate market share. Big holdings of ours, HDFC Bank, Kotak Bank, and in the NBFC context, Bajaj Finance comes through. So COVID, in a way, becomes the trigger which drives consolidation in the largest sector in the stock market, and it's too delicious an opportunity to miss, which is why a month back we opened a product called Kings of Capital, just focused on this consolidation play. We think it's an epic play. It's been a long time coming, and COVID will basically put the on switch, flick on the on switch for consolidation in this big sector.
Sure. Interesting, a move coming in on an Interglobe Aviation, for instance. PVR, also Saurabh, has been seeing some sporadic traction. Do you think it's finally time to go contra on these discretionary plays, consumption plays, if I can call it that?
I think you're right. They are the best plays in their sector. I think PVR is the best multiplex play in our country, and Interglobe by some distance today is the best run airline. But the reason we've never been convinced enough to put our money behind these is we don't see free cash flow. Right? Because you don't see free cash flow, earnings growth becomes a challenge. So these are the two best plays in their sector. and yet their ability to generate return on capital above cost of capital remains a challenge, which is why, say, in PVR's case, you see repeated fundraisers because the fundraisers, in effect, drive the growth of the business. So good companies, unquestionably, market leaders, both PVR and Interglobe, but the lack of free cash flow generation means that the Marcellus team stays away from these super franchises.
Saurabh, in terms of the recovery, the unlocking, you're sounding fairly, gauging from your commentary, sounding fairly optimistic that the pace will continue. I just want to get a better sense from you, because there have been some concerns, even while some data has been good, that perhaps there may be an on and off effect with this lockdown or gradual unlocking. And, while some numbers are looking good, like the initial pickup when it comes to the auto sector, for example, or online, etc., that it may not sustain. Do you feel we're entering a longer period of consolidation, or do you actually see momentum continue to pick up pace if you're confident of the recovery?
So I think that the data both from the macro side, and I'll comment on it in a bit, the data on the macro side and the company-specific data that's coming through, whether it's Berger Paints results, Voltas results, Asian Paints results, or Titan's commentary about July, August sales, the company-specific commentary that's coming through, the macro data that's coming through, and most importantly for us, our checks with dealers and distributors across the country, all of that is pointing to a pretty broad-based recovery. It's pointing to a pretty broad-based recovery. So whether we are calling up dealers and distributors in Tamil Nadu, in the cities or in the countryside, or in Bihar, in the cities or in the countryside, the picture that's coming through is a pretty uniform pickup across the economy. FMCG, consumer durables, auto, as you mentioned, even the good lenders are reporting big drops in their Morat books, improvements in collection efficiency. And my reckoning is this should sustain, right? Provided there isn't another twist in the COVID tail, provided there isn't another nasty twist in the COVID tail, this looks like the first year of a 2 to 3 year pickup, and there are underlying dynamics which are driving it. On the macro data, it's very difficult to get a CPI print close to 7% without a solid uptick in demand, right? And the CPI data, 7% driven by food inflation, is almost a certain indicator that demand is outstripping supply. It's very, very difficult to get that sort of punchy CPI read without some degree of economic uplift, which is why we're increasingly confident that we're in the first year of a 2 to 3 year economic recovery. And I've said this before, US goes into recession in year T, India's economic recovery begins in T+1. So it's a age-old pattern which has worked for 40 years. And it looks like the combination of cheap oil and cheap money once again is helping our country come out of the doldrums.
So then, Saurabh, and I know you've reiterated several times during this lockdown, the advice to stick to certain names, the market leaders, and from a longer-term perspective. But would you continue to buy in at dips at these levels? And when you're monitoring the market and monitoring the recovery, would you continue to add on to those stocks? I mean, how would you shape the portfolio going forward?
So I think there's two ways to look at it. With names like the consistent compounder names like Asian Paints, Pidilite, and Nestle, and HDFC Bank, really there is no point in timing these stocks. They have given you 30, 40 years of consistent growth in earnings, even in the quarter ending June, our consistent compounder portfolio earnings growth was a mind-blowing 15%. Right? So if you can grow at 15% through the quarter ending June, just imagine the strength of these franchises. So there are viewers, we will just keep buying steadily as investors give us money, we keep buying steadily. That being said, as I just said, we shut the Little Champs product. We shut our small cap product to inflows because a month back we realized we were getting too much money and it was becoming very hard to find stock in the market. Or that's another way for me to say we didn't want to bid the stock price up and buy at crazy levels, which is why we shut the small cap product to inflows. So yes, on large liquid established giants, we are happy to keep buying through the next 1 or 2 years. Similarly, in the Kings of Capital, companies like HDFC Life, ICICI Lombard, those sorts of high quality insurers alongside a Kotak Bank and HDFC Bank are part of it. We are happy buying them over the next 1 or 2 years. But in small caps, because of the illiquidity of it, some of them have rocketed and we've become a little wary of that. But overall, I think that the reason I keep reiterating the market leader point is there's another reason. If we go through a high inflation phase, and this might last, this punchy CPI inflation might last if demand continues ripping through. If we go through a high inflation phase, a market leader is much more able to pass that on to its customers. It has the strength in its brand and its distribution to pass input cost inflation back to its customers, and thus protect the shareholder. The number 3, number 4 players don't have that pricing power, and hence you as an investor suffer margin dilution, which is another reason for looking very carefully at your portfolio and saying, am I with the strongest player in the sector? If I am not, what am I doing invested in this stock?
Fair point. Saurabh, frankly, the learning experience for all of us has been the consumer's ability and willingness to come back. How much of the consumer willingness and ability is powered by liquidity, government support, low interest rates? Because when we know that the demand is not there, and if consumer interest and consumer demand is back, it could be 50%, it could be 60%, it could be 80%. But ultimately, what is driving that?
So I think that's I would say the $2 trillion question today, Nikunj. We're doing a fair bit of work on that. Our reckoning is more than government support. What seems to have happened, right? And it's still work in progress, but I think this is what's happening. I think that the big lenders who have strong balance sheets, the lenders who have strong balance sheets, the lenders who already raised that $5, $6, $7 billion of capital, these guys are turning their firepower to the smaller towns and cities, right? And we're talking about, say, HDFC Bank, Kotak Bank, Bajaj Finance. These sorts of guys, we reckon, are turning their firepower towards lending to smaller cities and towards lending to rural India. They're enabled in this regard with two different things. The amount of smartphone data that's now been collected over the last 6, 7, 8 years on rural India. And the second thing is the fact that for 5 years now, this financial system has gathered data on Jan Dhan Aadhaar accounts, right? So the Jan Dhan accounts were opened in 2015. They've had 5 years of direct benefit transfer. So you've got a good chunk of data on 200, 300 million Indians who are outside the credit mainstream historically. And with good monsoons, a good kharif crop coming through, my reckoning is that the credit disbursal has been swung sharply towards people less affluent than us, because without that, this sort of sharp uptick in auto and consumer durables could not have happened, right? This sort of blazing recovery you're seeing in auto and consumer durables is suggestive of a fundamental shift in credit disbursals towards smaller towns and villages. And this could sustain, I reckon, over 2 to 3 years, and that will give the recovery a specific shape and a pattern which could make it far more sustainable than perhaps many of us are fearing at this juncture. But I stress this is work in progress. We're trying to figure out. We are also bewildered by the pace of the recovery in consumer durables and auto, and we're doing more work on this. But our reckoning is the smart lenders have swung their credit machinery towards smaller towns and villages. And if that is so, this could sustain nicely for 2-3 years.
So how does one participate in this rural comeback boom? Should one buy companies which give low-cost housing to rural India? Should one buy rural-facing FMCG companies like Imami or Dabur? Shouldn't one buy two-wheelers because that's a play on rural India? How can one really bet on Bharat rather than India now?
So whenever whenever at school there used to be hard questions and easy questions in the exam, I always prefer to answer the easy questions first. So our easy way to deal with to tap into the rural boom, the sum of the portfolio additions we made is in some of our portfolios we've added Maruti. We added Maruti through June in some of our portfolios. We've had Eicher Motors for the last 8-9 months. So I think Bullet and Royal Enfield should be a nice beneficiary of a rural pickup. And through in early July, we added Escorts with its recovering tractor business with a good Japanese JV. We added Escorts. So those are our first plays on this. In the Kings of Capital portfolio, we have put some rural-oriented lenders. We've spent a fair bit of time over the last 2-3 months figuring out who is the best lender in the rural context. Obviously, the household names, HDFC Bank, Kotak Bank, those are sort of pan-India lenders. They will have a rural book, but that's part of the story. So we're doing more work on who are the best rural lenders, and we will focus on a couple of lenders who have very strong rural franchises. I just want to do a little bit more work on that before I open my mouth in the public domain. But rural lenders and auto to us appears to be the straightforward ways to play it. Historically, if you look back at the 2009, 10, 11 rural boom, building materials also did well. So at a later stage, we'll try to do some work there to say, will the building materials sector, will that stage a comeback if smaller towns and villages come back? Because then the story that played out so nicely through 2014, 15, 16, 17, which is tiles, sanitary ware, etc., could come back again. But we haven't got there yet. As yet, we haven't been able to do the necessary work on the building materials sector. So lenders, rural-focused lenders, and the auto segment is our current way to play this rural recovery.
Great. Saurabh, as always, you've covered so much ground and been so clear in defining your strategy as well. As we wind up, any one near-term trigger that you're keeping your eye on over the next few months as we've gone past earnings and just tracking overall metrics in the market, but anything that's going to be specifically on your radar?
Let me give one positive and one negative trigger. Our math suggests that the government has held back some of the fiscal stimulus. So the oil price fall from $80 to $40 gives India around 3% extra fiscal room, of which we reckon the FM and PM disbursed 2% in the press conferences held a month back. So there's 1% odd left, and we're trying to figure out when will that final blast come. Something tells me in the winter before the Bihar elections we might see another fiscal stimulus, and in parallel I think there's RBI action to come as well on the monetary side. The negative one is just look out for financial system distress. As we discuss, as the restructuring proceeds, a lot of banks, especially PSU banks and NBFCs, will suffer. So look out for financial system distress. We are obviously going to try to profit from it, but at the market level, there could be jitters as some of the prominent lenders face big write-offs in their shareholders' equity.
Saurabh, thanks so much for joining us this morning.
Thanks,
great chatting with you as always. Have a great day.